Good afternoon, everybody. This is Dr. Kashif Piracha, and I'm coming to you from Houston, Texas. Thank you so much for watching this webinar. This is a webinar that we did a couple of days ago with Mike Wu Ming for the Physician Docs Talks Facebook group. And a lot of people attended the webinar, and we got some great feedback. And we tried to record the webinar. However, we ran into some problems with Zoom, and it could not get recorded. And a lot of people were unable to tune in at that time and have asked for the recording. So we're going to do the whole webinar again. That's why I'm re-recording it. And I appreciate that you've taken a time to take a look at it. And in the beginning, I just want to tell you that this webinar is just an introduction to options trading. As you know, options trading is a very broad and diverse topic. And if you've already been trading options, then a lot of stuff that I'm going to go over, you probably already know. This webinar is mostly geared towards people who are starting in options trading and a beginner's class. That's what it really is. So we're going to go over some basic concepts of options trading and why it's so important. I've been trading options for the last few years. I'm a practicing internal medicine doctor, a hospitalist in Houston, Texas. And I started trading options a few years ago because I did my research, I read up on it, and I realized that basically we can get much better returns from the market by trading options than simply buying mutual funds over a long period of time and expecting our money to grow. As you know, if you have a diversified mutual funds portfolio and you are expecting long-term growth, the usual long-term growth is about 10% per year. And you have to hold your mutual funds for a longer period of time so they can ride out the up and down volatility of the market. But basically in options trading, you can get better returns than easily better returns than the 10% provided by the S&P 500. And if you learn how to do options trading in a reduced risk manner, that you learn the strategies that are employed, then your returns can be even better. But we're going to go over all of those things in the webinar. So thanks so much for joining me, and let's go ahead and get started. So obviously first I want to go over the disclaimer. So stocks and options trading involves substantial risk of loss and is not suitable for every investor. The valuation of stocks and options may fluctuate, and as a result, clients may lose more than their original investment. The impact of seasonal and geopolitical events is already factored into market prices. If the market moves against you, you may sustain a greater loss than you initially anticipated. You are responsible for all the risk and financial resources you use and for the chosen trading system. You should not engage in trading unless you fully understand the nature of the transactions you are entering into and the extent of your exposure to loss. If you do not fully understand these risks, you must seek independent advice from your financial advisor. All trading strategies are used at your own risk. The materials covered during this presentation are only for informational and educational purposes. So let's go over some of the basics, okay? So what exactly is options trading? So options trading is an attractive trading strategy that utilizes stock options to generate above market returns while keeping risks much lower than buying and selling individual stocks. And I only put stock options, but to keep it simple, but I just want you to be aware that options can be traded on ETFs. They can also be traded on some bonds, and they can be traded on indexes as well. Options are contracts between buyers and sellers. Both parties have a pre-specified set of rights and obligations. With options, money can be made whether the market goes up, sideways, or even down, because there are multiple strategies that can be employed for any conceivable market condition. So a lot of times, a lot of people are unsure trading in the stock market because obviously they don't know whether the market is going to go up, whether the market is going to go sideways, or whether the market is going to go down. So not knowing whether market will go up or down is not a hindrance because there are multiple strategies that can be played to generate profit no matter which way the market goes. The beauty of options trading is that there are strategies that are that can generate profits if the market goes up. Then there are totally different strategies that can generate profit if the market goes sideways. And then there are totally different strategies that can generate profit if the market goes down. So based upon what your perspective on the market is and what your outlook is, you can design a strategy for any one of these scenarios. And that's why options trading is so versatile and so successful, because you can tweak the strategies in a way that suits your outlook on the market, no matter which way the market is going. So I want to make you aware that there are 21 million option contracts that are traded on the stock exchanges every day. That's about 3.7 billion trades per year. And basically what I've observed in talking with a lot of physicians that I know, and even other people, that physicians are not really trading options the same way that they should be. One of the most important things that I've learned is that as physicians, we have a lot of money compared to the general US population of professionals that are not physicians. A lot of physicians have more than $100,000 in their IRAs or 401ks from a current employer or previous employer, and a lot of physicians are just investing that money in index mutual funds, and I think they are missing a very valuable opportunity of trading options, which can generate much more profits than simply buying index mutual funds and hoping for the price to appreciate over a longer period of time. One of the most common questions that physicians always ask is because they are busy, they have office, they have to see patients, they have to round in the hospitals. Our jobs are not easy. There's a lot of running around. And a lot of people think that if you're trading the stock market or you're trading options, that you have to sit in front of the computer 8 hours a day, all 5 days a week, but that's simply not the case. Most of the times, I enter my trades on a Monday morning, and then after that, you can just monitor on your phone through your mobile app. And the only time you really need to log in is if you want to close your trades or you want to adjust your trades. And if it's a weekly strategy, then most of the trades usually expire on Friday, and you can make the adjustments on Friday. But I just want to assure you, it's not something that you have to sit in front of the computer 8 hours a day. Once you've entered your trades, you can just monitor them through the mobile app on your phone. Okay, so now I've got a few slides that go over why trading options is a better strategy versus simply trading stocks. And that's the single biggest question that physicians always ask me. Because as you know, most people, when they think of the stock market, they think that they have to buy shares of a company, and then the price of the share has to go up, and then they buy low and they sell high, and they make profit based upon the difference. That's more than 90% of the people who invest in the stock market, in individual stocks. That's what they're trying to do. So why is options trading better than trading stocks? Why am I making a case here that physicians should look deeper into trading options? So options give a trader the ability to control 100 shares of a stock at a much lower price than buying the shares outright. So let me give you an example. So suppose Facebook is trading at $268 a share. If you want to own 100 shares of Facebook, that requires an investment of $26,800. But if you just buy one option contract on Facebook, and every option contract has 100 shares in it, then you can just buy one option contract on Facebook for just $630. So compare the $630 investment to $26,800 investment. That's just 2.35% of the total cost. However, in both cases, once you've purchased 100 shares of Facebook, you control 100 shares, whether you've got the shares or whether you've got the option contract, but any profit you will make as an options trader is going to be much superior because your initial investment is just $630. So in a nutshell, it's more cost efficient to buy options because you need less capital upfront and the percentage of profit that you make off of it is much higher than if you were to purchase 100 shares of the underlying security. Okay, the second point about trading options, why options trading is better than trading stocks, is risk mitigation. So options are much less risky than owning a stock or ETF outright. So in cases of owning a stock, you can lose 100% of your investment if the stock price goes down to zero. Now, obviously, of course, a lot of bigger companies, they're not just go down to zero, but theoretically, the risk is always there. However, in case of options, all you're going to lose is the premium that you paid to the seller. So let's go back to our example in the previous slide about Facebook. If Facebook stock goes down to zero and you had purchased 100 shares at 26,800, you lose all of your investment. That's a 100% loss, and that risk is always going to be there with any individual stock. But if you only bought one option contract that has only that costs you only $630, then all you're going to lose is $630. That's a very small amount as compared to buying the 100 shares. And so it's always less risky to buy options as compared to individual stocks, but they let you control 100 shares as if you were owning 100 shares. Okay, the next example is that options have much broader application. So most retail investors make money in the stock market by purchasing shares of a security and hoping for price appreciation to make a profit. But with options, good profit can be made whether the market goes up, down, or sideways. There is no market in which option trading is not profitable. And that's a point I already made. But obviously, with stock trading, there are usually only two ways individual investors make money trading stocks. Number one, if the stock price goes up, you can buy low and sell high and make money on the capital appreciation. And the second option is the dividends that the stock company provides. But even if you add the two together, the amount of profit you're going to make is always going to be much less than if you had traded options in the same stock. Okay, number 4, with options you can generate a weekly paycheck, you can also generate a monthly paycheck. You can choose the duration that you want to trade your options, and you can choose multiple durations. You can trade some options for a week, some options for 2 weeks, 3 weeks, 4 weeks, even 2 months, 3 months. So you can even ladder them. Like you can have some options that are going to give you a weekly paycheck, some a little bit longer. Most of my option strategies utilize a weekly paycheck. So what happens is that many heavily traded stocks have options that expire every week. So if we can employ strategies to generate a payday every Friday. So if you want to wait longer times, you can always choose the duration that suits you. And that's the beauty of options trading. It is highly customizable to fit your schedule and preferences. So you can tweak it whichever way you want, and you can make a profit based upon whatever your underlying strategy is and what is the duration of your strategy. So let's look a little bit deeper into what an option contract actually is. Okay, so there are two types of basic option contracts, calls and puts. And most option contracts control 100 shares of the underlying security, meaning one option contract equals 100 shares. Now, that's a simplistic statement. There are some securities and indexes which are priced, whose price is just so high that not everybody can afford to buy one contract for 100 shares. So some option contracts are called mini contracts, and mini contracts control only 10 shares, but they are very few, and still more than 90% of options available on the market, one contract controls 100 shares. So all option strategies are composed of some combination of calls or puts. So there are two parties in each options contract. One is a buyer and the other one is a seller. And every option contract has a strike price. This is an agreed upon price of the stock that both the buyer and the seller agree to when the option contract is initiated. This is the price that ultimately the options contract can be exercised if the buyer chooses to do so. And we'll talk more about exercising and everything in the later slides. So again, just to continue, every options contract has also an expiration date. Any decision regarding that options contract, whether the buyer is going to choose to exercise it or whether the buyer is just going to let it go, both of those decisions have to be made by the expiration date. If the option contract is not exercised by the expiration date, it will expire worthless. There is a huge organization called Options Clearing Corporation. They oversee the whole process and make sure all buyers and sellers abide by the rules. So now I'm only going to talk about very basically about a call option and a put option. And always remember, these are the two most fundamental types of option contracts, and all the strategies, all the basic and advanced strategies are all based upon some combination of calls and puts. So let's go ahead and understand calls and puts first, because it's absolutely important to understand what a call and put option is before you can initiate any kind of options trading. So let's talk about the call option. A call option gives its buyer the right but not the obligation to purchase 100 shares of an underlying security at a strike price. The seller of the call option is obligated to sell 100 shares to the buyer if the buyer chooses to exercise his or her right. In exchange for giving the buyer this right, the seller receives an amount of money upfront called premium. The premium always stays with the seller, whether the buyer exercises his right or not. And it must be noted that a buyer doesn't have to exercise the contract if he or she doesn't want to. He or she can simply sell the contract to the market to generate a profit if the contract is in the money. So I know this is a very busy slide, but let's go over some of the things that it talks about, because it's absolutely important that you have a good understanding of what a call option is before you can either buy or sell. Okay, so when you buy a call option, what you are basically doing is that you are telling the seller who sold you the option that you have a right to buy 100 shares of a particular stock at a fixed price by the expiration date. Now, the reason you're going to do that is that your market outlook says that the price of the stock is ready to go up significantly before the expiration date. So you're going to choose a price that the stock is most likely trading at right now. That's your starting point. But the strike price that you're going to choose is going to be the strike price that you think that the stock is going to be valued at when you are buying the stock. So let me give you an example. Suppose a stock is trading at $100 right now, and you think that in 1 week the stock is going to go up to $110. So what you're going to do is you can buy an option, a call option from a seller, saying that you are going to buy the shares you have a right to buy the shares from him for $102. So what you're going to do is, if the stock price does go up to 110 and you have a right to buy from him at $102, then that right is very valuable. You can theoretically buy the shares from him at $102 and immediately turn around and sell it to the market at $110 and make $8 per share profit. So that's basically the underlying concept behind buying a call option. So the seller obviously is not going to benefit if the stock price goes up to 110, because what will happen? At 110, if the stock is trading at 110 and you tell him that you're going to buy from him at $102, then that's a big disadvantage to him. If he didn't enter into a contract with you, he could have sold it for $110 in the market, but he's going to have to sell it to you for $102. So that's a disadvantage for him. So that's how the contract, obviously the buyer has a different perspective and the seller has a different perspective. But because you're buying this right from him, you're going to pay him a premium, and he's going to keep that premium if you buy the shares from him or if you don't. So that's why a seller, when he sells that option, he benefits up front because he's collecting the premium from you. So now let's go to the other side. What is a put option? So like I said before, if you buy a call option, you're going to benefit if the price of the stock goes up. That strategy, buying a call option, is a bullish strategy. You employ that strategy when your outlook on the market is to go up. Now let's look at a put option, and this is exactly what I was talking about when I told you that in options trading you can make strategies in which even if the market goes down, you make a profit. So let's go through what a put option is. A put option gives its buyer the right but not the obligation to sell 100 shares of an underlying security at the strike price. The seller of the put option is obligated to buy 100 shares from the buyer if the buyer chooses to exercise his or her right. In exchange for giving the buyer this right, the seller receives an amount of money called premium upfront. The premium always stays with the seller whether the buyer exercises his right or not. It must be noted that a buyer doesn't have to exercise the contract if he or she doesn't want to. He or she can simply sell the contract on the market to generate a profit if the option contract is in the money at expiration. So let's understand a put option, and let's go to the same example I gave just a couple of minutes ago about the call option. But now we're going to look at the opposite side of the picture. So suppose a stock is trading at $100 per share, and your outlook is that the market is going to go down, or that this company is going to go down, and your assessment is that the company stock is going to drop from $100 a share to $90 a share, right? So how can you benefit from it? You benefit from it by buying a put option. So what exactly is a put option? When you buy a put option, you are telling the seller who is selling you the put option that I have a right to sell the shares of this company to you at $98 a share, right? So let's see how this strategy will work. If the stock price does go down to 90 as your assessment was, now how can you benefit from it? Now remember, if the stock is currently trading at 90, if you were to sell the stock in the market, you'll only get $90 a share. But you've already purchased a contract saying that you have a right to sell the shares at $98 a share. And the seller has agreed to buy from you at $98. So you can sell the shares to him at $98, and as compared to the market price, that's $8 better. So that's the advantage of the put option. And the seller has to buy from you. Because why? Because when you bought that option, you gave him premium. He has taken your premium, so he has to sell it to you. But again, if you look at it from a seller's perspective, suppose your assessment was wrong and the stock doesn't fall, then he keeps the premium and there's no benefit to you. You lose your premium. Now, there's one thing that I want to specify here. For both the call options and the put options, a call option gives you the right to buy the share, but you don't have to. If the expiration date comes and you don't want to buy the share and the stock price has gone up, you can sell the whole contract for a profit. And I'm going to give you an example for doing just that. And the same goes for put option. If you have bought a put option and you really don't want to sell your shares, for some reason you want to hold on to them, you can sell the whole contract if the stock price has gone down for a profit as well. So let's go through an example. And I know I already said a lot of things about calls and puts, and maybe it's a little bit jumbled up in your mind, but please stay tuned, and I assure you that the example I'm going to give is going to make it much easier for you to understand. And so let's go through it. So this is a real example. These numbers that I'm going to share here with you are real numbers, and none of this is made up. So on Monday, July 6th, Apple stock was trading at $373 per share. So a trader has two choices to make money. If the trader is bullish on the stock and expect the stock price to go up, he can just buy 100 shares of Apple, or he can buy one call option that controls 100 shares of Apple. Now, what happens in this case? The Apple share that was trading on Monday, July 6 for $373 went up $10 per share in 5 days. By that Friday, the stock was trading at $383 per share. Now we have two different scenarios, and we're going to look at how a trader can benefit from those two scenarios. And then you're going to see how powerful options trading is as compared to buying the stock of the underlying security. So let's get started. So in scenario one, a trader buys Apple stock for $373 per share. Okay. So for 100 shares, $373 per share multiplied by 100 shares, you're going to have to give $37,300 to buy 100 shares of Apple. Now, in this case, in 5 days, Apple stock goes to $383 per share. So what this trader does is on Friday, he sells the 100 shares for $383 per share. $383 multiplied by 100 is $38,300. So what is the net profit that this trader has had? Is $38,300 minus $37,300. So this trader made a profit of $1,000. But the important thing is, what is the percentage profit? How much money was invested on which he made $1,000 profit? So the percentage profit is $1,000 over an initial investment amount of $37,300. That's 2.68% in 1 week. Not bad at all. But as you will see in just a moment, how much better this trader could have done if he had traded options. And also, let's not forget that the downside risk is 100%. If Apple stock goes down to zero, because it's most likely not going to happen, but because some theoretically catastrophic news or whatever, you can lose, or the trader can lose all $37,300 that he has invested. So the downside risk is 100%. Now let's look at this example. Now this screen that you are seeing over here is how an options screen looks like. And I know it's very scary because it has all these numbers. For right now, I don't want you to worry about any of these numbers except the ones that I've circled in red. So So right here at the top is the trading day. So this is Monday, July 6th. On the left here is Apple, and AAPL is the stock symbol for Apple, and 373.85 is the price of one share of Apple stock that it was trading on that day. These are calls. So this is an example about a call option, not a put option. So it's a call option. That's why I've circled calls. Now let's look here. This is 10 July 2020. That is the date of expiration of these option contracts. So as you can see, we're buying on Monday, July 6th, and these contracts expire on Friday, July 10th. It's a weekly contract. So let's look at some of these prices here. So what I want you to look at is this 375. So what the 375 means is that you are telling the seller who's selling you that option that by Friday, July 10th, you have a right to purchase 100 shares from him at $375 a share. Now, because he's giving you this right, you have to pay him premium. And here's the premium. So the premium is $4 per share. So let's sum it up. You buy a call option on Apple stock on July 6th, Monday, for a strike price of $375, expiration date 7/10 for $400. So $4 per share, and like I told you, every option contract has 100 shares, so $4 per share times 100 is $400. So your initial investment is $400, and you pay $400, and you have now a right to buy the stock at $375 by Friday, July 10th. So now let's go to July 10th and see how the math is going to work out. Okay. So as you can see here on the top, this is July 10th, Friday. The Apple is still there in the corner, but now the stock price has changed. Apple is trading at $383 right now. And now look here, it's still the 375 call option that you bought. But now you have to understand how it all works. Now you have two choices. You can buy 100 shares for $375 a share and turn around and sell all those 100 shares for $383 a share. You can make $8 a share profit. For 100 shares, you can make $800. Now that's one scenario that you can do. But here comes the other scenario. Now look at it this way. If you sell the whole contract to someone else, whoever buys the contract from you has an advantage because they can buy the shares for $375 and sell it for $383 themselves. You may decide to sell the contract, the whole contract, to someone else because you may not want to pay $375 per share for the stock. For some reason, you don't want to pay that much money. But now this option contract that you initially paid $4 a share for has become more valuable because it's now in the money. Because whoever holds this contract has an advantage. They can buy the shares at $375 and 2 minutes later sell them for $383 and make $8 a share profit. That's why the value of the whole option contract has gone up from $4 a share to $7.80 a share. You see that? That's what the $780 per share amount right here is reflecting. So I prefer the second strategy, selling the whole option contract. So let's see how the math will work. In this case, you sell the option contract for $780. Remember, $7.80 per share times 100 shares, $780. So what's your net profit? You made $780. You take out the $400 that you initially invested, you have a profit of $380. but look at the percentage profit. That's where the real kicker lies. You made $380 on an initial investment of $400. That's a 87.50% return. This return is 33 times better than scenario 1, when the trader had purchased all 100 shares of the underlying security. And what's the downside risk? That's what I love the most about options. The downside risk is only $400. Compare that to the first scenario when the downside risk was $37,300. It's mind-blowing. This downside risk of only $400 is 93 times better than scenario 1. So now you see the power of options trading. And if this is a lot of numbers and stuff, you can always re-watch the whole thing. But options trading, when you do the math, is so much more powerful than buying or selling the shares of the underlying security. So now let me give you another example. Let's compare apples to apples, okay? So as we said, the trader in scenario 1 bought 100 shares and gave up a price of, he had to purchase for $37,300. Now, suppose the second trader says that he has $37,300 and he wants to use that just to buy call options on Apple. So let's see how that math will go. Now we already said that one call option was $4 per share, or for one contract was $400. So now this trader has $37,300. If he pays $400 for one contract, he can buy 93 contracts. Now on Friday, when he's gonna sell his contracts for $7.80 per share, his amount that he will generate from selling the 93 option contracts will be $72,540. Now compare that to the $1,000 the trader got in scenario 1. This is 72 times more than scenario 1. If that's not eye-opening, I have never seen anything so remarkable like that ever. So let me finish with this slide. What is the bottom line? The bottom line is options trading is a highly profitable strategy that's employed by millions of traders worldwide every day. It is time physicians get serious about this. I see physicians are doing a lot of things. They're investing in real estate, they are investing in syndications, they are investing in crowdfunding, they are investing, they're buying properties and flipping them and doing all that kind of stuff. And they're doing chart reviews. There's a whole lot of things physicians are doing, but that's what I've spoken with a lot of physicians, and I can tell you, physicians are lagging far behind any other professional group in options trading. You don't have to wait and work until your late 60s or 70s and just waiting for the 10% return from the S&P 500. You can make much more efficient money by trading options. You just have to know how to do it, and you just have to be able to manage risk. People think options are complicated, but they don't have to be. You can just do simple option strategies like buying or selling a call or put, and this can lead to enormous returns, as I've shown in my previous example. A lot of people think options are risky, but they don't have to be. You can take as little or as much risk as you want to take. And I can tell you from experience that in a wide majority of cases, your returns will be far superior to than simple stock trading. Even if you choose conservative strategies that don't employ a lot of risk. Now, I just want to finish up by making a couple of other points. The first point is obviously that you have to learn about it and you have to know what you're doing before you do anything. So one of the best ways that you can approach options trading is by trading in a paper account. A lot of brokerages have paper accounts, which means that you can trade with simulated or fake money, and you can put trades and you can see how those trades turn out. And obviously everyone has to do that. When I started trading options, I had to do that. Never play with your real money until you've gotten your feet wet by practicing in a paper account. So let me end here. I hope that this was a beneficial webinar for you. I hope that the materials that I presented, you think they are valuable and they've given some value to your time. And I hope that you're going to like whatever I said. And please go ahead and share your feedback, give us your comments, and we are soon going to be back with another webinar, and we're going to go through options trading, and we're going to continue to educate you so you are in the best position to make the best decision for your financial future. Thank you so much for joining me one more time, and I wish you all the best. Thank you.